Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Thursday, everybody. Today's episode is very heavily focused on the economy. Yesterday, we covered the annual economic policy setting event, the Central Economic Work Conference, looking mostly at the official language and analyst commentaries. Today, we start by briefly noting the market response. Investors were not impressed by the lack of strong stimulus signals. In trading on Wednesday, all of China's major capital markets were down, despite North American markets seeing strong gains. Some commentators were shocked that the market would be surprised by this at all. US-based China Beige Book wrote, quote, "Who are these disappointed investors, and where do they get their information from? Serious question, because after 3 years of this, most sane people would eventually question their priors, or their advisors." End quote. These disappointed investors obviously don't watch China Update. This year has not been a good year for China's capital markets. In November alone, foreign investors pulled $3.7 billion from Chinese equities and bonds, and 2024 isn't looking much better. Yesterday, Wednesday, the IMF published a new report which predicts that elevated geopolitical risks and a change of investor sentiment would hold back foreign investors' interests in Chinese stocks and bonds in 2024, estimating that Chinese stocks and bonds would see an outflow of over $65 billion next year from foreign investors. The report writes, quote, "We project continued net outflows of non-resident capital from China in 2024 after significant outflows in 2023. Net outflows of non-resident portfolio deals are projected to remain substantial at $45 billion in 2024. Despite the US Federal Reserve's halted rate hikes, the wide US dollar-yuan yield spread will likely persist due to the People's Bank of China's dovish stance." End quote. The report argues that the main downside risk is deteriorating relations with the West. Quote, "Flows to China will continue to be held back by elevated geopolitical risk and a change of investor sentiment." End quote. Next up for the economy. Yesterday, Wednesday, the People's Bank of China, China's central bank, published official numbers on November's credit supply and similar data, which have some economists concerned. Aggregate financing, the widest measure of credit, that is debt, provided to the economy rose 9.4% year-on-year. Peking University professor of finance Michael Pettis, examining the numbers, observed, quote, "Total social financing, that is debt, rose by 2.45 trillion RMB in November, equal to about 20% of the month's GDP. This raised outstanding total social financing to 376 trillion RMB, or just under 300% of China's gross domestic product. At the end of 2022, total social financing was equal to 284% of China's GDP. End quote. Thus, incredibly, despite a year which was supposed to see a strong rebound after years of zero COVID, China's growth this year was fueled by a 16% increase in the debt-to-GDP ratio. Remember, this is not a 16% increase in debt, but its ratio to GDP, a measure of the system's debt servicing capacity. Interestingly, however, analysts' concerns were not about how fast credit grew in November, but how slow it grew, suggesting poor allocation of this credit. China's M1 money supply measure expanded at the slowest pace in nearly 2 years. Loan growth disappointed too, with 1.09 trillion yuan of new loans in the month, much lower than the projected 1.3 trillion yuan. Tellingly, the biggest component in monthly credit growth was the issuance of government bonds. So the economy has been driven by government spending, not private spending, which is likely the reason for the poor credit allocation. Quote, "Slowing in both M1 and M2, growth reflects lackluster credit demand outside policy-sensitive sectors like infrastructure and government bond issuance." End quote. After the weak credit performance, the People's Bank of China is expected to deliver more modest policy easing in the coming weeks. Capital Economics said in a note, quote, Broad credit growth continued to rise in November thanks to a pickup in government bond issuance, but it still came in below expectations. We think further policy support is on the way, but this is unlikely to drive a substantial acceleration in credit growth. End quote. Next up, we have two more developments to cover. Hey everyone, if you enjoyed today's episode of China Update, I have a huge favor to ask. If you are able to subscribe and hit the like button if you have not already, this is the primary way in which this channel grows. It just takes a couple of clicks of the mouse, but it's a huge help. And for those who want to help keep the channel financially sustainable, this channel relies primarily on subscriber support to keep going. Patreon and Buy Me a Coffee links are in the description below. Thank you so much everybody for that support. Next up, with so much poor news recently, it's nice to cover a more promising development. The PRC has put the world's first high-temperature gas-cooled reactor, Pebble Bed Module, HTRPM, into operation in Shandong Province, eastern China. This is the first of the so-called fourth generation of nuclear power plants. UK-based outlet World Nuclear News reported on this technological achievement, writing, "It follows a successful 168-hour demonstration run by the reactor in Shidaobei in Shandong Province, which is currently operating at 2 times 200 megawatt power. The plant features 2 small reactors, each of 250 megawatts, that drive a single 210 megawatt electric steam turbine. It uses helium as coolant and graphite as the moderator. Each reactor is loaded with more than 400,000 spherical fuel elements, pebbles, each 60 millimeters in diameter and containing 9 grams of fuel enriched to 8.5%. Each pebble has an outer layer of graphite and contains some 12,000 4-layer ceramic-coated fuel particles dispersed in a graphite matrix. The fuel has high inherent safety characteristics and has been shown to remain intact and to continue to contain radioactivity at temperatures up to 1,620 degrees Celsius, far higher than the temperature that would be encountered even in extreme accident situations. First concrete for the demonstration project was poured on December 2012, the alert continues, with the operating permit granted in August 2021 and the plant connected to the grid in December 2021. The plant has more than 2,200 sets of first-of-a-kind equipment, including more than 660 sets of innovative equipment. The supporting fuel elements production line has the largest production capacity in the world. Chinese financial media outlet Yicai writes that more than 500 companies took part in the design, research, development, production, and operation of the plant, and almost 94% of the equipment and devices used there were made in China. Adding, citing an advisor to the Committee of Experts of the China Nuclear Energy Association, that many Chinese provinces, such as Jiangsu, Guangdong, and Guizhou, plan to build similar reactors. This is indeed a significant achievement for China and hopefully a step in the right direction towards more green energy production in a nation which currently leads the world in burning coal. Finally for today, as China's crippling housing crisis moves into yet another year without resolution in sight, the government continues to roll out more support for the real estate sector. In a well-published interview with state media yesterday, Minister of Housing and Urban Rural Development, Ni Hong, said that the state was to set up a whole life cycle management system. What does this mean? Well, it looks like Beijing is going to pour a lot of resources into this policy approach, so we need to take note of Ni's explanation, which we're now quoting in translation. This is a fundamental solution to solve the problem in real estate development and promote the stable and healthy development of the real estate market, he explains. The past development model, which pursued speed and quantity during the phase of solving the availability issue, is no longer suitable for the current stage of addressing the quality issue and the new requirements of high-quality development. It is urgent to establish a new development model. What makes a good house? It should be green, low carbon, intelligent, and safe, ensuring that residents live healthily, use it conveniently, and find it cost-effective and reassuring. In terms of system and mechanism, one aspect is to establish a new mechanism linking people, housing, land, and money, starting from the scientific allocation of element resources. In terms of implementation, it is necessary to effectively carry out the 3 major projects of planning and constructing affordable housing, transforming urban villages, and building dual-use public infrastructure for both normal and emergency situations. Under the new model, real estate companies need to have a clear understanding that what matters now is high quality, new technology, and good service. Those who can build good houses for the people and provide good services will have a market and development. We will have to see how this is implemented, but it does very much read like an attempt to fix a deep structural problem through government fiat, which doesn't deal with the underlying fundamental economic issues. A property bubble, for example, or massive over-leverage among developers, or critically, the entrenched vested interest issue of local government fiscal revenue being dependent on land use sales. The housing crisis will continue to bleed into 2024, and we will continue to follow it here on China Update. That is today's episode. Thank you so much everybody for watching. Have a good Thursday, and I will see you all tomorrow.